Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Tariffs go live. President Trump delivers on his threat. Canada and China retaliate. Stocks post their worst day of 2025. Oil falls and spread widens as growth fears mount. Turning up the heat on Zelensky, President Trump pauses all U.S. military aid to Ukraine. Europe readies up to 800 billion euros of defense spending. Good morning, Manus.
Danny, good morning. That's what you call building the defense dam. Stocks are just trying to calibrate themselves. We've dropped by 1.76% yesterday on SPOOs. The Nasdaq down by 2.64%. We are live. The VIX is the highest since 2025. And this volatility, let's see where it goes. There's no room left. $900 billion worth of imports from Canada and Mexico, with a 25% tag on them. China, pretty measured response. We'll talk about that in a moment. We're in an air pocket of activity, according to JP Morgan, and oil down for the third day. Danny, down 4% over 3 days as OPEC readies itself to add more barrels in the eye of potentially a growth slowdown. The bond market year-to-date lows. There's a whiff of stagflation. One could say the growth bears are in charge here. Just look at that ISM data yesterday. The new orders, the biggest one-month drop in 5 years. So we're just seeing a steadiness on these yields, but the low for the year in the U.S. Dang.
Now pricing in 75 basis points of cuts for the year. Man, some individual stocks that we are also keeping our eye on this morning. TSMC, that seems to be continuing its rally this morning. Let's get a check on those prices. It is up 1.33% in the pre-market. It announced plans to invest an additional $100 billion in U.S. plants. It will boost chip output in the U.S. and support President Trump's goal of increasing domestic manufacturing.
Otker shares jump after the infrastructure software company reported its earnings. They beat. They were stronger than the forecast, Danny, up 16% and change.
Also, Walgreens, that is also higher in the pre-market trade by nearly 6%. It's up on reports that Sycamore Partners is nearing a deal to buy the drugstore operator, taking it private, and that could lead to its breakup and end a tumultuous run as a public company.
And in just a few moments, we have Mark Haefele from UBS. He'll join us. And then Stephanie Roth from Wolfe Research a little bit later in the hour, dissecting these live tariffs that we are in. President Trump follows through on his threat to impose additional tariffs on Canada, Mexico and China, sparking a tit-for-tat. Beijing slapped levies on the U.S. goods. Canada responded with a sweeping package of counter-tariffs targeting American cars, trucks, steel and aluminium. Brendan Murray, who heads our global trade coverage, joins us now. So here we are. We are live, $900 billion on Canada and Mexico. We've had the Canadian response. Just frame this for us, Brendan, in terms of the scope of what is covered and the response and the risk.
Yeah, so we haven't heard from Mexico yet, but they've held their cards a little more closely to the vest. But undoubtedly, we will see a retaliation from Mexico, if not today, then very soon. So what we have is a situation that we haven't faced in a long time: a big regional trade war among traditional trade allies. So as you said, this is a total of $1.5 trillion worth of goods that flow across these two borders. It's on the magnitude of 5 times bigger than the amount of goods that were tariffed during Trump's first term, something like $300 or $400 billion worth of Chinese imports. So the real question now is how much pain economically will be created before the dividends that Trump thinks will be paid on these tariffs will be seen. The price of consumer goods may not take that long to show up at the grocery store and the drugstore and the consumer electronics store and the auto showroom. So we're looking at industries that have to some extent anticipated these tariffs, but eventually those padded stockpiles will run down, and they're going to start paying that extra 25% tariff for Canada and Mexico and 20% on China, and start saying, I've got to raise my prices. That's what a lot of economists are saying in their research notes this morning, and that's how we'll have to see the market reaction to whether that hurts companies' bottom line as well.
And I guess we can call this round 2 of tariffs, since we already had 10% on China, and now we have this. What's next in the tariff timeline? What else are we expecting from the White House?
Well, the president has laid out a number of additional tariffs. We have steel, 25% tariff on all steel and aluminum imports. That comes next week, so March 12th. Then by April 2nd, he's put a number of other threats on the table, tariffs on pharmaceuticals and lumber and a number of other products, chips and cars. So there's a whole host of other tariffs that are coming down the pipeline, and many of them will be used for negotiation to drive the parties to the negotiating table. But as we've seen over the past 24 hours, some of those threats are being turned into reality.
Brendan, a fast-moving story. Thank you for helping us keep track of it. That is Bloomberg's Brendan Murray. Risk reaction yesterday was swift. We saw the S&P 500 post its worst single-day drop of the year, erasing gains for the year, now down 0.5%. These were the worst performing sectors. The worst of it all was information technology, down 3.5%, followed by energy, consumer discretionary, and materials. Joining us now is Mark Haefele, CIO of UBS Global Wealth Management. Mark, I'm sure you've been a very busy man fielding phone calls left and right, so thank you for making time for us this morning. The reaction wasn't one of sell the importer specifically. It was risk. It was all risk getting sold, and things like information technology, the big technology stocks, NVIDIA getting hurt specifically hard. I wonder what you make of the market reaction, whether it was logical, and how it evolves from here.
Yeah, you're right. It's been busy. I think that one of the things we highlighted last week when we came out with our monthly update is, for a variety of reasons, we're entering a period of heightened volatility and uncertainty stemming from a lot of policy. So, of course, first is the potential for a government shutdown. And then, as noted, we have a lot of tariff news coming out, especially when we get to April 2nd, where the government releases a lot more data on all the countries that have wronged the United States on the tariff front. So while the overall picture for the economy and our base case, we still think that the U.S. economy is strong, sustained tariffs, particularly on Canada and Mexico, will start to bring down growth forecasts, but also kind of hamstring the Fed, because they don't know what the inflation outlook would be. So I think that's why certainly, sentiment wasn't great last week. It's not going to improve with these increased uncertainties this week.
Mark, good morning to you. I like what you say, which is it's very used. Stay grounded in the data, separate rhetoric from reality, and diversion of direction. The data is slipping, Mark. Whether you like seasonality or not, Atlanta GDP, the new orders yesterday, and the ISM and consumer confidence, there is slippage. What does that translate for you to risk?
Yeah, well, look, a lot of that data is survey data. The S&P 500 earnings were very strong. And of course, what are they going to do forward? And some of that sentiment data matters. But I think that we're really going to have to look at what's going on with jobs on Friday and continue to follow this. If this slowdown from the great consumer spending that we saw and the strong performance into the end of the year, how much this is just a kind of a dip, or this is just eventually so much uncertainty and so much disruption around trade starts to bleed into growth and also potentially inflation.
Mark, you make a great point, and Bank of America just put out their earnings sum that we're up 15% year over year for the fourth quarter. That is the strongest quarter since the fourth quarter of 2021. So earnings have been remarkable. But all you need to do is look at what some of these manufacturing companies were saying in the ISM survey that Manus has been talking about. Over and over again, they talk about the inability to do business because of the uncertainty of what tariffs look like. Is there a period where there are scars left on companies, Mark, from this, of uncertainty, if you're a manufacturing company, what you do, or just in general, the amount of CapEx or deals you can make in this environment?
Look, it certainly feels that way, right? Because the Trump administration's agenda has both a business-friendly, pro-growth side to it, but also has a cutting spending and a potential inflationary side. And it does seem that they've kind of front-loaded the the cuts and the uncertainty rather than the pro-growth side. So if this continues, if the tariffs start to stay on with, and this isn't just negotiation, then I think a lot of the people who are betting on a Trump put are going to start to really question that. So we're in a challenging period. I think there were signs we knew this would be a challenging period, but it's here and it doesn't feel good.
What do you think the Trump put is this time around? Trump 1 was about stocks. We're just showing the performance, testing the Trump put on the S&P 500 since inauguration. It's hardly horrendous, and some say maybe the Trump put this time is the 10-year yield, which is down and continuing lower, Mark.
Well, speculating on what goes on in Donald Trump's mind is not something that I do. I do it very reluctantly, and we don't know. I mean, I think we do have certainly the words of Treasury Secretary Bessent about the focus on the 10-year yields. I wouldn't focus so much on levels, but their mindfulness that both the inflation picture and the growth picture go into that, and they need to manage both of those things. And then, of course, to be a business-friendly president and to see, say, the S&P 500 fall below where it was when he was inaugurated, there'll be a lot of press on that.
Of course.
Let's just put it that way.
Look, yeah. and you're right. We're trying to speculate the inner workings of the president's mind, and that's a fool's job. Risk was disrupted yesterday. Credit, oil, stocks, Bitcoin, the whole plethora was disrupted. I know that you like investment-grade bonds. I know that you like gold. But when you look at credit spreads, they popped to the widest since of October last year. When you see disruptions like that, is that an opportunity to take corporate risk because you look through the disruption?
Well, I think that the fixed income portfolio, the focus on quality, that's really there as a portfolio stabilizer. I think where we would start to look, and it might be a little too early, is on some of the broader themes we like in equities, like power generation, and like things around AI. So because we still think both of those are going to continue to benefit from the global build out of AI. Which is going to go forward. We can debate about the near-term growth rate on that, but those are the places where we would be most focused on looking to buy the dips.
Okay, long live AI. Mark, thank you very much. Mark Haefele there of UBS setting the agenda this morning on Bloomberg Brief. Bloomberg Brief. I'm Manus Cranny alongside Danny Berger right here in New York. Well, President Trump has ordered the pause of all military aid from the U.S. to Ukraine. The move stops weapons in transit to the country at war and freezes billions of dollars of payments that were scheduled. The move turns up the heat on Ukraine's president, who has to demonstrate a commitment to peace to earn back this support. Let's bring in our EMEA News Director, Ros Matheson. Ros, the scale. I want to understand the scale of what has been halted in terms of forward military aid, and what is a demonstration of good faith?
Well, it's potentially very significant what's been halted because Ukraine relies very heavily on the US for military aid. That's aid that's both currently en route, by the way, to Ukraine. It's aid that's sitting in Poland ready to be transited into Ukraine, and it's further commitments of aid going forward because under the Biden administration, they front-ran a lot of military aid into Ukraine for this reason, out of concern that things would slow under Donald Trump. And here we are now at an actual pause in military aid. And that means that Ukraine's at risk of running very low on weapons as soon as the summer. We're talking about tanks, armored vehicles, munitions, everything, including ammunition, but also those long-range missiles have been very useful for Ukraine, both to defend its skies against Russia, but also to push its own troops into Russian territory under air cover. And those troops are still in the Kursk region of Russia. And that's a potentially significant bargaining chip for Zelensky in any conversation with Russia. And so if they have to pull back, obviously, that's a weakening for Ukraine. So we are talking about quite a significant impact on the war on the ground, and pretty quickly.
And Europe's waking up to the reality that they are perhaps at it alone. European Commission President Ursula von der Leyen was speaking about an hour ago saying that the loans for defense spending could total something like 800 billion euros. Roz, let's just take a listen to what the president had to say.
We are in an era of rearmament. And Europe is ready to massively boost its defense spending, both to respond to the short-term urgency to act and to support Ukraine, but also to address the long-term need to take on more responsibility for our own European security.
Roz, can you just put in context the level of spending that we're hearing about from the Europeans?
Well, that's right. As you heard, we heard Ursula von der Leyen talking about spending hundreds and hundreds of billions of dollars on defence, which sounds like a lot, but there's a lot of steps that have to come before any of that money really sees the light of day. For a start, we have to have this discussed in greater detail and then presented to leaders of the EU, possibly towards the end part of March, but with a lot of caveats, because countries like Hungary have indicated they don't support this. Other countries already expressing reservations about having to find extra money for defence spending at a time their economies are already in a pretty fiscal tight spot, and they're taking money from other areas of their economies to do so. So this is no slam dunk for the EU. And even if these packages get sign off and we start to talk about increasing defence spending, that's something that's going to come over a period of many years. This is about a future-proofing Europe in a way in its defence. It's not about immediate change you're going to see in the next couple of months. And that may not be fast enough for Donald Trump, who's very keen for Europe to show very tangibly that it's doing more to spend on its own defence.
Donald Trump certainly not waiting for others. Roz, thank you very much. Bloomberg's Roz Matheson. And on that point, now that we have 20% tariffs in effect for China, China has been announcing retaliatory measures. Here is the latest. China is halting imports of logs from U.S. companies, from some of them, and soybeans. This is specifically from 3 different firms. China already announced today that it would also impose additional tariffs of up to 15% on some U.S. goods starting on March 10th. So again, this is halting the imports of logs and soybeans from 3 U.S. firms. We'll have more coming up on your Bloomberg Brief. Aramco is planning to cut the world's biggest dividend. The move could affect Saudi Arabia's budget, which relies heavily on Aramco's dividend payouts. Let's bring in Bloomberg's Jomana Bersetchi in Dubai. Jomana, great to see you this morning. What brought us to this place?
Yeah, hi guys. So Aramco earnings came out a little bit earlier. Operating profit down 11% year on year, pretty much in line with analyst expectations. The view was that they would actually see a drop in both revenue and in profit this year because of, one, lower oil prices, but of course lower production as well, with Saudi Arabia producing sub 9 million barrels a day, away from their full potential. So there's still a lot of spare capacity there. But I would say that the big focus for the investment community was on that dividend and the guidance that they've given for this year. They have said that they expect the total payout for 2025 to come in at $85 billion. That compares to the $124 billion that was paid out last year. Now, you will remember that they started paying out this performance-linked dividends. You've got a base dividend and then a performance-linked dividend after the major windfalls that came through following on from the oil price spike in 2022. And since that point, they have honored those dividends. But towards the end of the year, the financials started to become a little bit not sustainable because they paid out more in dividends than the free cash flow that they were generating. So the expectation from the analyst community was that they would have to do something about the guidance of that dividend in 2025. So it's come through this morning. But also it is of particular interest because, as you know, about 97% of the Aramco stake is held by the government, either directly or via the PIF. And so it is an important source of revenue for the government at a time when, of course, the Saudi Arabian government is spending a lot. But what it really encapsulates as far as Aramco are concerned is that, number one, they are very much still focused on the financials of the company and have had to do a reevaluation of the size of the dividend that's paid out. And number two, despite those linkages to the government, they've decided to do a mark-to-market of the dividend payout that is feasible.
Jemana, very briefly, we see OPEC taking action to add back barrels. Is that political pressure? What's going on within OPEC? Because it's an interesting move.
Yeah, it is. And many in the analyst community thought that the OPEC Plus group would once again postpone the decision to put extra oil barrels back to the market from that April deadline. But they haven't. They announced yesterday that they are going to proceed as planned. You will start to see a gradual increase of oil barrels coming back to the market, the tune of about 160,000 barrels a day. On the back of that, we have seen some downward pressure on energy prices. But to go back to the CEO of Aramco today, they think that oil demand is going to be very strong this year.
OK, well, certainly it's on the back foot. We're at a 3-month low, and output is rising to a 1-year high. Jemana, thank you very much, covering the oil stories from Dubai. Jemana Busechi there. More breaking news on tariffs in just a moment from Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
Tariffs go live. President Trump delivers on his threat. Canada and China retaliate. Stocks post their worst day of 2025. Oil falls. Spreads widen as growth fears mount. And Trump turning up the heat on Zelensky. The president pauses all U.S. military aid to Ukraine. Europe readies itself with an €800 billion defense spending.
Well, yesterday was a tough day, Manus. We'll see what today brings, but it started with ISM manufacturing showing new orders falling into contraction. Then the room for negotiations end, the tariffs go live, and we have our worst day of 2025. We add some weight to that sell-off this morning, down about 1/10% rather, for the S&P 500. Russell 2000, those underperform. Well, we get another bad day. Mag 7 now down more than 10% in the past 2 weeks. Nvidia down 15%. Year to date. Now, for this bond market, trading almost as if it is a growth shock and perhaps an inflation scare. A full 75 basis points are now priced in by the December meeting. Your 2-year yield, that gets a bid. Again, that assumption that we will get more cuts coming from the Fed. We are at 3.92%. Your 4-year yield and 30-year yield, little change this morning, 4.1% for your 10-year yield, Manus.
And that's the difficult balance for the Fed, Danny, isn't it? That whiff, as Mohamed El-Arian said yesterday, and other notes have said it, that whiff of inflation, when does the whiff of stagflation, when does the whiff of stagflation turn into a bit of a stink in terms of the growth versus inflation? And that's the balancing act for them. Do they lean more into the growth slowdown relative to the inflation?
Well, it's hard to kind of gauge whether what we're seeing now truly is a growth scare. A lot of people point to the fact that it's a lot of sentiment surveys, not necessarily hard data. You are seeing, though, more executives start to talking about this idea that it could be a recession. Goldman Sachs' David Solomon yesterday saying there's a very small chance that the economy tips into recession. Barclays also yesterday writing a recession in the U.S. remains improbable, but it is no longer unthinkable.
And this adds into Torsten Slok. It's sort of a mini growth slowdown, but it is, in his view, not a recession. We've had some breaking headlines over the past 30 minutes, if you're just tuning in. More reciprocal tariffs coming from China, halting the imports of logs, soybeans, again, going back to Trump 1, and we talked about this. So there's incremental but calibrated response from China at this stage.
Well, that's what makes this so hard to understand what the fallout is, because it's not just what sort of tariffs and how long will tariffs be put on from Trump, but what the retaliatory measures look like.
Well, let's talk about those. Investors are bracing for the economic fallout from these tariffs. Stephanie Roth is the chief economist at Wolfe Research. Good morning. Good to see you.
Good morning.
There's just headline whiplash every day. When you look at the policy mix, and the three of us were just talking about this is a fairly toxic bag of policy that you're dealing with at the moment. Is this kind of the worst case scenario, or is it how long did these tariffs endure for? How do I read this?
The combination of the policy mix probably couldn't get worse at this point. Of course, things could always get worse.
Yeah.
But if you were to define something that's really quite negative for the economy, this is it. We have government layoffs, the private sector is getting squeezed. We have these massive tariffs, which, by our estimates, that could shave about 1 percentage point off the U.S. economy. And the fallout could be pretty significant. Our base case at this point is the tariffs won't last that long, just because they don't really make that much sense in the first place. We're tying these to fentanyl trafficking and migrants, right? And the fentanyl from Canada is largely non-existent. The flows are incredibly small. And from Mexico, they've made significant improvement. So base case at this point, and I think that's what the market is suggesting too, is they don't expect them to be lasting. Otherwise, you would expect to see a much more significant hit from the market today. Down 10 basis points on the S&P, that's not all that significant considering the extent of the potential economic damage from all of this.
I mean, to be fair, though, most people thought we wouldn't even get to this place. And I wonder, Stephanie, even if this doesn't last that long, even if it's a week of tariffs put on and then there's some sort of backtracking, I asked this to Mark Haefele of UBS earlier, but are there not scars that are left of companies that realize the uncertainty of the environment that they're in? You get less capex, you get less spending, you get less deals, that something continues to creep on even if the tariffs are taken away?
Yeah, I think that's fair. You'll have a little bit of a headwind on capex this year. It's hard to make investments if you have no idea what the tariff rate's going to be and whether you can pass that on. So I think that's fair, but at the same time, the economic damage would be significantly limited if we do, in fact, remove them in just a matter of a couple of weeks.
When you look at the data, and again, Mark had this to say, look at the data, stay steady. You look at some of this at the moment. The Atlanta Fed GDP swings to negative 1.5% negative. New orders, the biggest one-month drop in nearly 5 years. Inflation expectations are rising. Again, that's a fairly toxic mix. Is that short term, and you think that will pass through and we will recover?
So it's interesting. I mean, the economic data so far have been okay in terms of hard data, right? The economy so far
This is soft survey data.
Right, this is soft survey data. The Atlanta Fed is significantly impacted by imports. Imports are because we're buying ahead of tariffs. That will go into inventories. So as of now, we're tracking Q1 GDP something around 1%. So not good, but not massively negative. If these tariffs, in fact, stay on place, then we're talking about a real significant slowdown for the rest of the year. But as of now, at least, the data are okay. Sentiment surveys are telling you that people are scared about the tariffs, and that's fair. They should be.
Yeah, I mean, to be fair, Atlanta Fed now falling to 2.8%, but the S&P's tracker is up 1.6%. So there definitely, to your point, are some differences there. Neil Dutta of Macro Research talking about this idea of a feedback loop, that you have growth slowing and you have a Fed in wait-and-see mode because of tariffs. So either someone needs to blink first, it needs to be a Fed that cuts, or Trump that takes back tariffs. Do you see that same sort of feedback loop happening, that the Fed is kind of stuck, that you don't think that they're going to take action necessarily until they understand what the ramifications of tariffs are, and that by that point it might be too late?
The Fed's going to have to react to the data, right? At this point, payroll should be okay. We're looking for 180,000 this week on non-farm payrolls. The Fed's not going to be able to start cutting rates unless they have significant financial market weakening, which so far that's not necessarily the case, and bond yields have come down as a result. Or we start to see the rising unemployment rate. And the policies, while they're bad, while sentiment is bad, they haven't had a real impact on the U.S. economy at this point.
But then here's the issue when it comes to this Tier 1 data, which is what the jobs data is. Is this the sort of the last significant good innings that you have before some kind of bleed effect from DOGE and other actions?
Well, I think that the Fed's going to look through at least the government numbers. They're going to probably be looking at private payrolls in the next couple of prints, knowing that DOGE is having an impact, and it's not for economic reasons. But if you start to see that bleed into the private sector, then that's where it becomes important, and then you'll see who's going to blink first.
In terms of the impact of the markets and what that tightening does, there was a study from Moody's that got some attention earlier this week that it was the top 10% of wealth in America, of those consumers, account for 50% of U.S. consumer spending. If there is real significant weakening in the markets, of the likes we've seen, again, it's not horrible yet, but if we continue to get that, is the economic ramification of it worse this time around just because of that concentration of consumer spending?
Yeah, I think that's fair to some extent. The above-trend consumer spending was in part driven by this wealth effect, combination of equities and housing net worth. Now you pull the rug under that under the rug of the consumer that's particularly at the high end that's been spending above their typical savings rate. I think that's fair. You'll probably see a significant slowdown from that perspective. Granted, like you said, we're just back to where we were a couple months ago in the market. I think you're going to have to see much more material weakening from that perspective. Something like a 15+% sell-off in the S&P, and we're not there yet.
And at that level, and again, this goes back to the debate, is what is the Trump put? Mark Haefele didn't want to go inside the mind, obviously, of President Trump. But we really haven't seen a significant equity drawdown yet. We've seen a few jolts in the Mag 7, but we've not seen anything catastrophic yet that would invoke a sort of a pullback from the Trump administration.
No, we haven't. And we don't really know where that Trump put is, but I do think it's notably lower than where we are today.
I mean, is there just this whole sense, though, that we're maybe underestimating the ramifications of this? Again, I go back to the idea that we thought these wouldn't be put in place. To your point, they don't really make sense. How concerned are you that we don't really have a full grasp of just how far Donald Trump will go?
Yeah, I think that's concerning. I mean, I haven't incorporated these numbers that materially into my outlook. If I were to take a 1 percentage point hit to my growth numbers, that outlook's going to look quite a bit different for this year.
How important, let's square off on this. How important is going to address joint sessions today? How important is it that this one big, beautiful deal goes through, that the tax bill actually gets done earlier in the year, not at the back end of the year? How important is that?
I mean, I think it's somewhat important. I mean, the most important thing is that it gets done, right? If we start to see a tax hike on the consumer for next year, then you're in real big trouble. But base case is this will probably get pushed into sort of towards later this year anyway.
Yeah, as we talked about heading into this year, that the sequencing is so important, and unfortunately, it's been basically all of the bad stuff for Stephanie. It is so wonderful to have you on. Thanks for waking up early and joining us. That is Stephanie Roth of Wolfe Research. Let's now get you some other top stories that are trending on the terminal this morning. We mentioned this one. Goldman Sachs CEO David Solomon sees, quote, a very small chance of the U.S. economy entering a recession. That's despite the uncertainty surrounding global trade policy. Speaking in Sydney, Solomon said that President Trump is acting on the view that imbalances exist in trade.
Aberdeen abandons its 2021 rebrand, renames itself as the Aberdeen Group. The asset manager has been contending with ongoing outflows. That's less than 4 years ago. The company dropped most vowels from its name in a radical rebrand. It now wants to remove, quote, distractions.
Great. Vowels are back.
I got it there. In the end, I got the vowels.
All right. Well, this one's quite unfortunate for Citi. Another multi-billion-dollar error at Citi. To be fair, the last one was a multi-trillion-dollar error. But according to sources, its wealth management business almost shifted about $6 billion to a customer's account by mistake. That's after a staffer handling the transfer accidentally copied and pasted the account number into the field for the dollar figure. And I ask Manus, why am I never at the receiving end of these errors from Citibank?
I would be so happy even just to skim the interest off the top of that in an overnight payment. I don't need the bulk payment. I just need the interest off the top.
Citi, you've heard it here first. Manus will send you his account number. He's happy.
I'd return it all. I would.
All right, on to serious matters. Coming up, we're going to talk about tariffs. President Trump follows through on the threat. We're going to have more of that next on your brief.
It is Bloomberg Brief. I'm Manus Crenny alongside Danny Berger here in New York. Well, tariffs are in effect. President Trump follows through on his threat of 25% for Canada and Mexico and doubles the levy on China. The retaliation has firmly begun. Canada responded with a sweeping package of counter-tariffs targeting American cars, trucks, steel and aluminum.
Meanwhile, we're learning this moments ago that China is halting imports of logs from the U.S. as well as soybean imports, specifically from 3 U.S. companies. Bloomberg's Enda Curran joins us now from Washington, D.C. And it's so much to sort through. Can you just kind of give us stock of where we stand at this moment?
So as of this morning, we now have tariffs covering $1.5 trillion worth of goods imposed overnight. That brings the tariff level to its highest since about 1943, according to one estimate by the Yale Budget Lab. And we're talking about tariffs on all goods coming out of China, not just intermediate components or national security-related products. It's across the board. And likewise on Mexico and Canada, with the exception of energy coming out of Canada, which will be tariffed at 10%. So it's obviously a very sizable development. It moves this trade war to the next level. It starts something of a global trade war because we're seeing the tit-for-tat now, the responses from Canada with immediate retaliation on tariffs worth of $20-odd billion US worth of goods. China, of course, responding with 15% tariffs, as you mentioned there, on agricultural products like soybean and the like. We'll probably get the Mexico response later this morning. President Sheinbaum expected to speak to reporters there. But taken all together, we've gone past now the kind of threatening phase to this new level of sweeping tariffs on goods between these major trading partners.
And we had that news alert, Enda, good morning to you, from the EU warning that transatlantic economic stability is threatened. Let's dig a little bit deeper into the China response. As Danny said, it's soybeans and logs in addition to the agriculture, but it's a calibrated, or people are assessing the China response as being quite measured and calibrated. Is that because Xi has a pretty critical NPC meeting this week?
Yeah, that's the immediate takeaway. So China has, of course, been quick to respond, 15%. Obviously on strategic areas like farming, trying to make the point that we can inflict pain on the US too, and targeting those GOP-sensitive electoral bases. But to your point, Manus, there is a view that it is, at the same time, somewhat measured. The government in China does have its big economic policy planning meeting this week, the National People's Congress. That's where they're going to agree on how much money they need to put into the economy, how much support to put into the economy. And then, of course, don't forget, this is only one part of the sequence of tariffs when it comes to China, because in early April, we're expected to get those reports back from the trade representative to the White House in terms of how the US is trading with China, how did the trade one deal with China play out, how does China protect US IP, and so on and so forth. And that's expected to lead to the next round of tariffs on Chinese goods, including sectoral tariffs, at which point negotiation may or may not kick in between the two governments. Presidents Trump and Xi have not had a call, actually, since President Trump took office. So, on the one hand, yes, somewhat measured by China, but worth remembering this is only one part of the sequence. More US tariffs on Chinese goods are expected maybe in early April. And then the big question becomes, are they going to start negotiating with each other or not?
Well, we're going to hear from the president tonight. He's going to be addressing a joint session of Congress for the first time in 5 years since he was last president. He posted on Truth Social last night saying, tomorrow night will be big. I will tell it like it is. And what are we expecting from the president tonight?
Well, a theme of renewal is what President Trump is expected to push, and it really covered a spectrum of issues. I mean, the first 6 weeks of the new president's term have been passing by at a frantic pace, Danny, as you know. Major developments on foreign policy, on security policy, on domestic economic policy, on taxation policy. So we're expected to hear rationale and reasoning behind the ongoing spending cuts, the efforts of DOGE. He wants to make sure that lawmakers are behind him on those measures. Get some signals from him on the tax package and the progress of that. Get some signals from him, of course, on broader trade policy in terms of where he's going to bring it next and how serious it is. And, of course, we'll get an update on his thinking on where he's going with national security and foreign policy too. Plenty of analysts are making the point it will be interesting to hear how much he adheres to the kind of messages that President Trump pushed himself on the campaign versus how much he adheres to some of the messaging that were pushed by, for example, Project 2025, which has also played an influential role. So it's expected to be a sweeping take on the kind of policies the president expects to roll out in his term, and also a kind of an effort to get lawmakers behind him and make sure that they're all rowing in the same direction.
OK, Enda, thank you so much. Enda Karen tracking the very latest on the tariffs. And let's focus on the president later on today when he speaks to the joint sessions of Congress. And President Trump, he also orders a pause on US military aid to Ukraine. Now, the move stops weapons in transit to the country. It freezes billions of dollars of payments that were scheduled. Our Brussels bureau chief, Kevin Whitelaw, is with us. Kevin, we're also seeing some breaking news headlines coming from Ukraine. This is from, I understand, from the Prime Minister, ready to sign a natural resource deal with the US, Ukraine to continue calm work with the US to secure a peace. Again, trying to rebuild bridges. But the scale of the pause of military aid, what is it? What's the scale of sort of pullback by the US? And what is this demonstration that the US wants to see from Zelensky in the Ukraine?
Well, obviously, this all follows that disastrous meeting in the Oval Office where President Trump, and Ukrainian leader Zelensky, got into a pretty ugly discussion. The U.S. has, under Joe Biden, had rushed as much aid and as much military equipment to Ukraine as possible in the days, weeks, and months leading up to Trump's inauguration. But obviously, that it takes a while for all of that to flow through. So I think we're still trying to understand exactly how much this really applies. A lot of these figures are held pretty closely, and you're talking about sensitive military equipment. A lot of it's anti-aircraft and other kinds of defense weapons, but also, ammunition and more offensive missiles. And so the exact mix of what Ukraine has, it can survive a pause for a while, but obviously at some point that's going to become a very, very difficult sort of crunch moment for Ukraine as it tries to continue to hold off Russia, which has been slowly in some places winning back bits and pieces of territory.
Well, the language coming from the Europeans, Kevin, has stepped up to a completely different level when it comes to their own defense spending and their willingness to do European-wide loans, to do pan-European loans. We heard from the European Commission President Ursula von der Leyen about an hour ago, a little bit more than that, talking about that. What level of spending are we looking at coming from the Europeans?
Well, she's laying out sort of a series of options that she's hoping that leaders will be able to discuss when they have an emergency summit later this week on Thursday, and yet again in another one 2 weeks from now. And those options include a $150 billion loan program that the EU is going to propose that would be aimed at boosting defense spending. But they're also talking about freeing up sort of what they call fiscal space, basically easing the bloc's budget rules for defense spending to allow governments to boost spending and really invest in that. She says that if all the EU member states took full advantage of it, that could be as much as $650 billion over 4 years. So she came up with a number of $800 billion total. But obviously, on some level, those are still sort of, guesstimates and wishful thinking until countries decide to make the decision to invest in that money, to spend it. They still have to actually, pass it through their parliaments and everything else. So we'll see what this actually means. But the conversation has definitely shifted as the EU shows that it has to demonstrate to Donald Trump and to the administration that it's very serious about stepping up its commitment on defense spending.
Kevin, thank you so much for that update. That is Bloomberg's Kevin Whitelaw in Brussels, and you're watching Bloomberg Brief. Get you ready for your trading day on this Tuesday. We're going to have some retail earnings. Target and Best Buy, they report before the bell. Nordstrom is after the bell. Then New York Fed President John Williams speaks at Bloomberg Invest at 2 p.m. Eastern, getting ahead of a blackout period. And President Trump addresses a joint session of Congress that will happen at 9 p.m. Eastern. Manis.
Danny, got a sea of green for you. You've got TSMC continuing to rally after they've announced their plans to invest an additional $100 billion here in the U.S. Okta, the shares jumped. The infrastructure software company reported earnings that beat. Nice strong forecast. And Walgreens up 5.6% on reports that Sycamore Partners are near a deal to buy the drugstore operator. And that takeover could lead to the breakup and the end of a pretty tumultuous run for a public company. Danny.
Take privates are in because deals have been stalling in this environment of tariffs and geopolitics. Just looking at some of the geopolitical fallout of more spending from Europe, Ursula von der Leyen announcing various packages that could total up to 800 billion euros, Manis. You got a German yield that's moving lower by 2 basis points in a euro that's at 105.
And just think of the divergence there in terms of the US pulling back maybe a little bit on its fiscal stimulus relative to Europe. And as one analyst said, it could be a mega moment for Europe. That's it from Danny and I on Bloomberg Brief. Surveillance is right up ahead.